All right, so look at overnight financing charges. So if you hold a position overnight, you're going to have to pay a financing fee. Yet there's a charge to borrow the money. Now, of course, this makes sense, doesn't it? Because effectively, if you're trading on margin, the broker is loaning you money. If you're only putting up 10% of the notional value, he's loaning you effectively the rest of that. He's loaning you the ability to use that as buying power. So you've got some overnight financing charges to pay. Now, I'm going to run through some examples here, and I'm going to kind of cover how it all works out and how it's calculated. The one thing to mention, I'll probably mention it a little bit later as well, is that if you're day trading, you don't have to worry about any of this. If you're not holding your position overnight, then you can have as much as you like, as long as you can pay the margin requirement. You can have a bigger position as you like. You're not going to be charged for it. So this is only if you're holding the position overnight. That's just how it works, guys. That's the way it is. So you're charged to borrow that money that's required for the position value. So, and that is a percentage of the notional size of the position, and it's normally kind of 2 to 3% per annum. We'll talk about really in depth how it's broken down, and then divide that by 365. So you get a per day rate. So they charge you that per day, and they just debit your account with that amount per day. Obviously, again, day traders don't need to worry about this. So an advantage if you are a day trader, slightly less financing charges. But of course, the flip side of that, just digressing slightly, if you're a day trader, is that you don't get the moves from gaps. So if markets are gapping overnight, shares are gapping overnight, you don't get the advantage or disadvantage of that. So the volatility is kind of dialed down a little bit, and actually a lot of the big moves happen overnight. So it swings and roundabouts with that. That's more of a trading strategy approach as opposed to looking at the details and the nitty gritty of how this works. So yeah, no financing charges for trades closed on the same day. You've just got your spread costs and your commission. So if you're just trading the index, you get your spread cost. Obviously, trading equities, you got your 0.1 on each side. So let's look at an example here. We've bought 10 contracts of the FTSE. We've got long at 6,700 in this example, and the notional value of that is £67,000. So how do they calculate how much you are going to pay to hold that position overnight? Let's take a look. So the financing rate is LIBOR, and if we go back to the slide earlier, we talked a little bit about terminology, and this is kind of one that came up, and that's the London Interbank Offered Rate. In other words, it's basically just the commercial interest rate. It changes every night. It's set by banks. You may have heard about the LIBOR scandal, but it's based on obviously the interest rate that the Bank of England has, but it's just the commercial lending rate. It's ultimately what banks are prepared to lend at to each other or what have you. Let's not get too deep into it. So it's LIBOR plus a 2.5% per annum. Again, this varies from broker to broker. You need to kind of look at your broker and see what they offer. But generally speaking, this is kind of be how it's going to be framed. It's going to be LIBOR plus a certain amount, and that 2.5% is the broker's kind of margin on the position. So, and they're just using a benchmark of LIBOR or whatever it may be, but they're adding a little bit of margin to it, which is understandable. They've got to make a living as well. So the total cost to hold this position overnight would be £67,000 times LIBOR plus 2.5%, which is 2.5 plus 0.5, 3% per annum, and then we've got to divide that by 365, and to give us our daily rate, and that is of course £5.50. So for every kind of day that we hold this, we're going to be charged £5.50 for this position. Now let's flip on its head. When we're shorting, we are credited with the overnight charge. However, when interest rates are low, this is often a debit, because of course we have that margin requirement coming in, not margin requirement, that kind of little bit extra, this rate here that the broker sets, this 2.5%, and this makes the difference, depending on how much this is. Of course, if this is high, if we're talking like 10% interest rate, then you're going to receive a decent amount of money, but otherwise it's generally going to be a debit. So let's have a look at it. So it's a credit, it's an amount that you're credited with. So let's look at that. We've got 10 contracts on the FTSE. Again, this time we're short 67,000. Notional value again £67,000. Financing rate LIBOR. This time it's minus a 2.5% per annum. So that's the LIBOR rate, and so that's giving us 2%, right? So cost to hold overnight is going to be £67,000 times minus 2% divided by 365 to give us our daily rate, and so that is going to be a credit of minus £3.67, and obviously a credit of minus £3.67 is a double negative, so it's a £3.67 debit. Now you can see though that if we had LIBOR 10%, all of a sudden that figure becomes 7.5%. 67,000 times 7.5% divided by 65, we start to get actually a positive credit, so we're going to actually get some money to hold the position overnight. There's some notes on this. Now for currencies and Forex, the same thing obviously. The rate is the central bank rate differential. So let's explain that in a little bit more detail here. It's the second quoted currency rate minus the first quoted currency rate. In other words, if you're trading the euro US dollar, your first quoted currency is euro, the second quoted currency is US dollar. So you've got your second rate, which is the US bank interest rate, the Fed interest rate, minus the European Central Bank interest rate. So whatever those two may be, so the net of those two, and then you're going to add plus 1% for long positions and minus 1% for short positions. Again, this is the broker's margin, just adding on. So slightly more complicated formula there, but ultimately, it's the same thing. It's just you're paying to hold a position, and it's kind of where the carry trade, comes from. If you've heard about the carry trade, the differential in interest rates, you're not kind of borrowing money in a low interest rate currency and then loaning it out in a high interest rate currency and pocketing the difference. Of course, the danger is that the value of those two, may change. You may well be pocketing a certain amount each night and each week, but you're also exposed to the capital appreciation or depreciation of the difference of those two currencies. Alright, so let's talk about dividends. I'm going to talk about dividends very briefly here because it's pretty simple. So dividends, if you bought a stock, you are going to get 100% of the dividend, and you have to pay your tax on it. You have to do all sorts of things with it. You sometimes get a certificate, all those kind of good stuff. Dividends are different with CFD because you're basically just buying a contract. You're not buying the underlying. You don't get the dividend. But of course, the broker has to give you something, because that's kind of a big part of why people will buy a stock or sell a stock. The dividends is a key part of it. So generally speaking, they're going to give you 80% of the dividend credited if you're long, and you're going to have to pay 100% of dividend debited if you're short. So something that you kind of think when you first start trading, I know I did, and a lot of people would say this, is like, well, actually, if I go short, I've been watching this, and prices when they go ex-dividend, which means the day that the dividend is paid, normally drop by the dividend amount. So if the dividend is 10p, the price generally gaps lower by 10p because that's the fair value of it. It's worth 10p less. And so people think, well, I'll just go short the night before, it'll drop 10p, I'll make 10p on it, and that's great. Yeah, okay, but you're going to have to pay the dividend, because ultimately, of course, you are selling stock that you don't already own, so you're going to have to pay that dividend to somebody. So just the way the broker works is, unfortunately, you only get 80% of the dividend credits if you're long, but you have to pay the whole lot if you're short. That's just the way it is. It's not really, CFDs aren't really the kind of thing that you want to be using if you're looking for a dividend portfolio. So just bear that in mind. So yeah, like I've pointed out here, I've not even read onto it, but dividend is not a free lunch. Ex-divvy gap does occur on the day of dividend. So two ways of looking at that. You can't just go short and get the gap down on dividend day and say thanks very much to the short, because you're going to have to pay for that anyway. And similarly, you can't get the gap down, if you want to go long and think, well, I'll collect the dividend. I know it's only 80%, it's only 8p, but I've got a decent sized position, that's still going to be a nice amount. Yes, but generally speaking, the stock will gap down by that full 10p. So in actual fact, you'll probably be down by 2p multiplied by your position size if you did that. Some caveats, and obviously sometimes the stock does that and recovers, or the market's already gapped up and it doesn't really gap down. But generally speaking, all said and done, when everything else is stagnant and every other variable is neutral, you are going to get that ex-dividend gap down by the amount of the dividend.